know many of you. If I don't know all of you, I'm Maureen. I'm Vice President of Philanthropy with PMD Alliance. And today's session is the third in a three-part series. This is brand new for us. And it's on planning and bringing positive change, clarity and positive change. We're really thrilled to have Debra Curry join us. She is the Director of Investment Strategies with Yosemite Capital Management. And today's session focuses on planning your gift. So we are really thrilled to have Debra join us today. I wanted to let you know that at the end of this series, we'll send a follow-up email, a wrap-up email, that'll contain Debra's contact information as well as mine. So please feel free to reach out to Debra. Or if you want to talk to me one-on-one, I'd love to chat with you. You know, we're in extraordinary times and unlike any other. And so we just are so grateful to you to travel this journey with you and to partner with you. So just want to say thanks for being here today. And I'm going to pass it over to my colleague, Amanda Fott-Nelson, who will kick us off. Thanks.
Hi, everybody. Thank you for joining us. We're excited to see some familiar faces. I just want to do a couple of housekeeping things. If you have questions, please drop them in the chat and I'll keep track of them until Debra's presentation is over, and then we'll try and get to everybody's questions. As Maureen mentioned, we will be sending a recap email. This is the last of our 3 Legacy Series programs. So we'll send an email recapping the series this week, and we'll include links to all the replays. So if you missed one, you can catch those later. And let's introduce Debra. Maureen sort of introduced her, but she is the Director of Investment Strategies with Yosemite Capital Management. But more importantly and more special to us, she's also very involved with Parkinson's. She's a volunteer. She's the president of the California Parkinson's Group Foundation. So it's a cause that's dear to her heart too. And we're happy to have her here today. And with that, Debra, I'll let you kick things off.
Okay, beautiful. Thank you, Amanda and Maureen. This is Maureen's thanking me for doing this, and it's actually part of what I do anyway, because you know, my background, I'm a certified financial planner, and so our firm talks to a lot of people about planning and gifting and legacies, and the same topics have been, you know, this is the third in a series. If you didn't see the first 2, I know they're recorded and they're very worthwhile. So I go back and listen to them because they kind of all fit together about planning and leaving a legacy. And, you know, as you can imagine, these days, there's a lot of focus on retirement and planning. I don't mean these days, 2020, I mean, these days in general, because of demographics. And for us in the Parkinson's community, my husband was diagnosed with Parkinson's 15 years ago. Our kids were 7 and 10, and he was 49 years old. So we've lived with this beautiful gift for all this time. And believe me, I know that planning's a challenge. So knowing that, I'm going to talk about things that Maureen asked me to discuss, which have to do with estate planning. And again, I'm going to assume you've listened to the other programs. I'm going to give you a little taste of some of the definitions, but if you have additional questions, I know the chat box is open. The other thing is, if you would be so kind, type what state you're in so that I can address, you know, there are rules that are different in different states. So I'm in California. I know we have people from Florida. I mean, if you would be so kind, type your state in, just so if there's somebody who's not in a state I'm expecting. But I'm going to talk about some of these things. And then if you need additional definitions, you can reach out to me, my contact information. You can put it in the chat to contact you about this. You know, we'll get back to you. We'll answer your questions. And my job is to educate you. That is my job. Anyway. The idea of this session is, how can you give charitably to an organization? And in planning for that, a lot of people plan, you know, the kind of known ways. Oh, I can leave it in my, you know, will, I can leave it in a trust, I can leave life insurance, that kind of thing. Now, keep in mind, a lot of people, believe it or not, I don't know, let's see, there's 25 of us here. On average, half of us statistically do not have a will or a trust. Half, probably more. Now, that doesn't mean you don't have an estate plan. Your state has a plan for you. If you and I get hit by the bread truck tomorrow, I live in California. California already has a rule for who gets what. When I tell people that, a lot of them are aghast because it goes, immediate family, sisters, brothers, and a lot of people are like, oh my God, I don't want my fill in the blank relative to get anything. So that's one thing. But let's assume that you're doing your planning, and let's assume you have a desire to leave some money to a charity. Any charity. It could be PMD, it could be cancer, it could be your alma mater, it could be anywhere. There's a lot of standard things. But a lot of times I talk to people about the value of doing things now versus later. Part of it is if you're giving a gift now, you get to see how it's being used and the benefit it gives to people. So that's really nice. Plus, especially now, 2020, a lot of charities could use your help. So let's talk about your choices. You can do it after you die. We already talked about that. But before you die, there are several things that you can do that may or may not be obvious. And now I have to get into taxes, which I know everyone loves. But the basic concept, yes, you can give money and that's fabulous, yay. But you also have some tax code goodies that help you. And the whole concept is if you bought something and it's worth more today, the difference there is a capital gain. That's a good thing. If you sell whatever that is, you may or may not owe some tax on that gain. So let's say you owe half. I'm making this up. You invested $100,000, it's worth $200,000, and you owe half. So that means what's left after taxes is $150,000. 100, 200, half of the 100 is 50. Hope I didn't lose you in the dust there. But basically, $50,000 is going to the IRS. That's one way of giving a gift. You can just write a check. Okay? You can sell something and write a check. But if you want to take advantage of the tax law, instead of writing a check, you want to give that asset directly to the charity. So let's talk about how you can do that, because then you don't pay the taxes. That $50,000 doesn't go to the IRS, it goes to the charity, which is better, essentially. Or you can give less and they get more for the less anyway. So first of all, the other thing about 2020 is there's some tax law changes that make things more advantageous this year. So that's just keep in mind, I'm going to talk in general and then I'll address 2020 later. If someone is over the age of 70 and a half and they've got a retirement account, an IRA, or they've inherited an IRA. My dad passed away. I inherited an IRA. I'm not over 70 and a half, but because he was, I have a requirement every year to take some money out of that account. There's a rule, a tax rule that allows you, instead of taking it out of the account and then it's taxable, same as the capital gain idea, the money comes out in a required minimum distribution, it's like paying yourself a bonus, you owe taxes. Well, there's a rule that allows you to give that required minimum distribution directly to the charity. So again, you bypass the tax people, they get all the money. That's something that's very important, and a lot of people take advantage of that if they're in the situation where they don't need that income, okay? Let me just see here, did I leave anything out on that? No, I did not. There are some new rules this year about that. 2020, anyone who has a required distribution where they make you take money out, that's been suspended. So you don't have to do it. But you can still give money direct to a charity in 2020 out of your IRA. So again, talk to your financial advisor, talk to your tax person. If you don't have one, we can connect you with the information, but I'm not telling you to do it. I'm saying it's a possibility, but you need to talk to your advisors. Let's talk about real estate. Again, if you're in the enviable position, I was reading an article this weekend about a guy who was talking about all his mortgages. I'm like, wow, must be nice. And he was talking about 3 mortgages. One was for a beach house, one was for his home, one was for his mom's, whatever. Well, let's say you're at the point in your life where you want to downsize and you would like to give a gift. There's a way of giving the real estate directly to a charity versus, again, selling it, having a capital gain, potentially paying tax on it. Again, we're trying to make our gifts the most efficient. And again, this is something you can do before you die. So that's the sort of thing you have to identify way before you do it. You can't put your place on. Yeah, let's put it this way: it takes some planning, and you need to talk to your advisors again. But it's definitely something. The other thing you can do is, let's say you have a piece of real estate. Renting it these days is kind of iffy, right? I mean, you know, rentals are not as locked as they used to be. There are people who are saying, well, maybe I'll just sell my real estate and I'll invest it in something, or I'll start living off that income instead. There's a way you can put that asset into a trust that upon your death will go to the charity, but you can live on the proceeds while you're living. Again, it's a planning issue, but it's something you can do now. There's also a way to put that into a trust and let the charity have money now. And you can take money out of it now. And at the end, it'll go to the charity. So there's a number of different things you can do with real estate that are very creative, that will cut out the taxes, that will leave more money for you to invest within that trust for your own income, and also gives the charity the growth of it over time. So that's something having to do with real estate. Appreciated stock. Everyone, believe it or not, if they're in the investment world, actually has appreciated stock if they've held it any length of time. Same kind of thing as with the real estate. Instead of selling it, paying the tax, giving the cash, you can donate the shares of stock directly. Amazon. If anybody owns Amazon, it's up a bunch. If you wanted to give a gift to your charity, the charity has to have an account set up to accept the shares, but your advisor, your brokerage firm, your E-Trade, whoever it may be, has a way to electronically, with your instruction, give it directly to the charity. It's an immediate tax write-off for you that year. So your taxes potentially go down. Again, I'm not your tax person, but it's a charitable contribution that reduces your taxes, and they get more money, and it accomplishes your goal of giving money right now. Same thing with the real estate. Let me go back to that. When you gift real estate into a trust that's going to a charity, it's also an immediate tax write-off. It's a little more complicated than that, but it immediately gives you tax benefits, even though you're still keeping some of the income. So there's some creative, hey, accountants are creative people, believe it or not. So on the stock issue, that's something that people are sort of familiar with. I don't want to run over my time here. How am I doing for time, Amanda? Good. Okay. There's another thing that you can do. Now, if you are, who do I know has got a foundation? Pick any big star. Kobe Bryant. You know, they have that big family foundation because they are very wealthy and they are able to give a lot of money to create a business that's job is to give money away. It's essentially what a foundation is. Job is to give money away. Well, not all of us are that wealthy, but the concept is still there. When you give money to a foundation, the money sits there, it's invested, and over time you distribute income out of it every year to some cause. It can be a different cause every year. Well, what do you and I do who are not Kobe Bryant or Beyonce or Tom Hanks, who have gazillions of dollars to set up our own foundation? There's a mutual fund type structure that allows you to do that, and it's called a donor advised fund. And it's kind of a cool thing, but it's not well understood. If you understand mutual funds, the concept is the same. You donate money, you're buying shares, if you will. You donate money to the donor advised fund. It's gone, it's no longer yours. It's a donation that year. It's the same as if you cut a check to a charity. Okay. However, the money stays in the account, in the fund, and you're able to ask the fund manager to gift to charities over time. So they invest your money along with the rest. It grows, hopefully, and you are able to give money away on an ongoing basis. So you give a chunk, let's say you give 100,000. I'm using big round numbers to make it simple. You give 10,000. You give 100,000 to this donor advised fund. You get the tax write-off that year, but you can continue to make gifts out of the donor advised fund for many, many years. Got it? Again, this is something you have to discuss with an advisor. It's not the sort of thing you just ring up E-Trade and say, I want to buy this. You just don't want to do that. There's some tax stuff going on. There's estate planning stuff. You have to take your time. Let me think here. Oh, so let's talk about 2020 in general. The rules having to do with gifting and write-offs. With the new tax law that passed in, God, what year is it now? The first year we had to deal with it was 2018. 2018. 2019, we're used to it. 2020, COVID blew up everybody's planning. What they did was the tax law changed how many taxpayers benefit from a write-off on charitable contributions. Not so great in some form or fashions. So it reduced the number of people who itemize. So if you itemize, you may know you do, you may not. If you don't itemize, it means you can file a 1040 EZ. I mean, you literally can just fill in the blanks and send it in online. It's pretty simple. So a lot of people, I'll talk about me, you know, I give money, I give $50 here every month, and I belong to a couple of different organizations. And so I would itemize all those things and get to reduce my taxes by them. In 2020, they went back and said, hey, anybody who doesn't itemize, who could normally not deduct contributions, you can deduct up to $300 of contributions in 2020. Cool. Okay. Itemizers, people who do all the complicated expenses, if you own a business, if you own a side business, if you are, trying to think, an independent contractor, you drive Uber here and there, any of those people who itemize. Now this year, you can deduct up to your income level for taxes. So it gives you a huge latitude of how much you can give. Now, I hope you can afford to give all of your income from all that. Most people can't. Again, Kobe Bryant could, not you and I. But the point is, the rules are different this year. Let me think if there's anything else I need to tell you. Yeah, I know there's one other thing. You know, life insurance, a lot of people think of, if you have life insurance and you list someone as a beneficiary, you list a charity as a beneficiary, that only happens when you die. You can actually gift a life insurance policy into a trust to give to a charity before you die. In other words, it hasn't paid off yet, but there's a way of actually gifting the policy itself to a charity when you, quote unquote, no longer need it. And again, that's a planning thing. That's something you have to talk to your advisors and but that's also out there, and a lot of people don't really think about it. So let's see here. I'm just checking to see. Yeah, that's all I can, that's what's in my notes right now. Are there questions? I'm sure there may be, and I will do the best at answering. But one thing I will say is everyone's federal tax rules are the same. Okay, the IRS rules are the same for everybody, but everyone's state rules are different. So Arizona, you guys have no income tax. Florida, you have no income tax. Hello, California, we do. Yeah. Colorado does. New Mexico, anyone? I'm not sure about New Mexico. I'm pretty sure they have a state income tax. So your federal, I was talking federal tax rules. Okay, I'm not talking about your state. And they can often disagree with each other. So there's another fun reason to talk to your tax person. But any questions?
It looks like we do have one. The first one is, can you buy a policy specifically for this purpose? I think it was Sarah. And which purpose, Sarah?
Gifting.
Yeah, gifting, like a life insurance. Can you buy one for that purpose? I'm
going to say I think so. And the reason I say I think so is I'd want to run that by a tax person first. I can't think of a reason why not. And it's, you know, a life insurance policy is an asset. So I don't see why not. I think one of the issues might be is it paid off? So there's some intricacies, but I think it's something that might be able to be done. I can look into it and let you know.
We do have a question from Ken. I have a reverse mortgage that is in the name of my living trust. Do the rules require the sale of the property, or can I give the property to a charity?
Ah, excellent question. So a reverse mortgage complicates things a bit. The general concept of I'm saying this for people who may not know, Ken, I know you know this, but when you do a reverse mortgage, essentially think of it this way. You own a home, you spent $100,000 on it and it's worth $700,000 today. If you were to sell it, there's that capital gain issue again. Let's not get into what's excluded. There's a capital gain issue. But how do you get to some of that equity and use it now versus letting your heirs inherit it? Because at that point, there is no capital gain issue. Okay. So it's a way I like to think of it as scooping some of your equity out before you sell the house. Okay. So reverse mortgage, what the bank's doing is they're sending you money out of your equity. So the complicated issue is in most reverse mortgages, if you die with it, there's an issue of what is the agreement with the bank. So I would go back to the people who you did the reverse mortgage with and ask them, what are the provisions upon my death? There's going to be more equity in the property. You know, you'll have given me this much and there'll be this much value. Can everybody see? You know, there's this much value and you've given me this much. So it's going to be reduced by that much, but there's going to be some left over. What happens to that equity? Can I put that into our agreement that I want that to go to a charity? It's going to depend on the document. In concept, whatever's left over is yours or your heirs or your beneficiaries to use as you want. So the general answer is yes, but the specific answer is that you need to talk to the people who wrote the policy.
Great. We have another one from Susie. Will anyone sell a Parkinson's personal life insurance policy?
I wish I could say yes, but the answer is no. Okay. Unfortunately. And I will say this group of people doesn't help, but I don't know about you guys, but people call me when they suspect that they or someone they know may have Parkinson's. And my advice to them is go get them insured right now. Get them life insurance, or if they have life insurance, they can boost, or whatever you can do all that stuff, because if they get diagnosed, they're no longer insurable, unfortunately. And there may be a few exceptions, but as a general rule, no, sadly.
We have a great question. What about property such as a car or an RV? If we donated this, are there tax benefits and deductions?
General rule, yes. You hear all those, you know, those jingles at the end of the year where they want you to donate your car to whatever the cause is, right? So yes, there is a tax benefit. I think you would want to talk to the charity and see, do they want it? For example, they may not be in a position to take care of that. But if you say, hey, I've got this and this is what it's worth and I'd like to give it to you, they may very well say, we will figure this out. Give us a little time.
Right.
Okay.
We actually do work with a nonprofit that helps us take cars. If somebody on our team could drop that link in the chat for Barbara,
there you go.
That would be great.
Yeah.
And we have taken a couple.
I normally find that if it has value, you can donate it, but you definitely want to do a little chatting ahead of time. And yes, there's a deduction. I don't know what the value, I don't know how they determine the value of the deduction. That's what I'm not sure of. That's a tax person question.
Okay. That's a great question, Barbara. And thank you, Rebecca, for dropping that link in. And on the Support Us page explains how we take car donations.
I didn't know that about you. Now I do.
Okay, we have another one. I always think that only people with lots of money do trusts. Is that true? I don't have a lot, so it feels like I would not be able to give PMD and Alliance a lot. Is that okay?
Well, I'm gonna answer both those questions. I know from working with charitable organizations, like our foundation is California Parkinson's Foundation, and originally started out as a support group for people who had been diagnosed under the age of 60. We had a lot of people in their 40s and 30s, and let's not get into that. But I know that we get a lot of donations that are $10 a month, $11 a month, $20 a month. So the size isn't necessarily that big a deal. And B, giving is more, I'm going to say giving for me, a lot of it is more about me and my priorities. And most charitable organizations are delighted with whatever you can give them. Now, that being said, let me answer your trust question. The reason you need a trust is to avoid having your estate, when you pass, go through the state's process. Got it? It's called probate. There's nothing scary about it, but depending on what state you're in, it can be long, it can be expensive, and it can be very unwieldy for your heirs. It just takes a lot of time. And so the whole point of a trust is to write the rules as to what you want done with all your things before you pass away. And that's a legal document. And then it bypasses the state, the courts, everything. It's done already. It's not permanent. You can change it. It's called a living trust for that reason. There are people of all different price ranges who can do them. But the whole point of a trust is to make your heirs' lives simpler. It's less to do about the amount of money. Now, it also depends on your state. California, it's a nightmare to go through probate here. Average of 18 months. And there's a stated fee, there's a set fee of 5% of the value of your estate, not net of things. So for example, you have $1 million home in California, that's not that expensive. You have an $800,000 home and you have a $700,000 mortgage, let's pretend. The fee, the probate fee to the state of California would be 5% of the 800, not of the net $100,000 that you actually own of that property. So it's expensive, it takes forever, it's incredibly painful for your heirs. So in California, a trust is like the minimum that you want to do. And it's every year, by the way. So if it takes 18 months, they pay the fees twice. Yay. In Florida, I don't know. In Arizona, I don't know. So that's why you want to talk to an estate person in your state. But the other thing is, if you have heirs, I'm looking, I don't know who here would have heirs that are under the age of 18. Do you want to leave them with a mess? Do you want to have them have to go to court? Do you want to have them deal with all that? No, you don't. And I will say that it's not as painful as people make it out to be. It actually is a real control thing. If you're a control freak like some people, it's kind of fun to actually put it all down on paper. And I will also say something about people with Parkinson's, and you're not going to want to hear this. But if you have Parkinson's, you owe it to your spouse, your children, whoever, to sit down with somebody who's a special needs trust person, because there's going to come a day where you should not be handling your own money. I'm sorry, but that's how it is. You don't want to hear it. I'm really sorry, but that's just the truth. And the problem is, the other thing is, so in our state, again, lovely California, very dear friend of mine and her husband went through this process. And what they did is they took everything out of her husband who had Parkinson's. They took everything out of his name. And then upon him becoming so ill, he needed to be, and she's a nurse, so she could really handle almost anything. But it got to the point that she couldn't take care of him and he needed to go to a continuous care skilled nursing facility. It was $15,000 a month. Because they'd done that planning, he owned nothing. The house was in her name. Everything was in her name. His IRA rollover had been given to her. He owned nothing. So that meant Medicaid paid all but $1,000 a month of that nursing home. So that was brilliant planning. So there's a couple of reasons why if you have Parkinson's in your family, you can't screw around. You need a trust and you need it now. Sorry, but that's how it is.
Oh, that's great. Debra, do you have advice on where people can find estate planning attorneys? And specifically, you mentioned special needs ones. Are there resources for that?
The elder care is what you're looking for. You're looking for an elder care attorney. And if you Google that, you can find them. If you're in California, I can give you names of a few. I wouldn't be surprised if in Arizona, PMD probably knows of some, but that's the area that you want, is elder care. And it's not as widespread as I would think it would be, honestly, but I make a point of figuring out who those people are. And we could definitely, if people are in a particular area and they're not sure, I am happy to look. If they say, hey, have you heard it? Can you look at this person, this person, this person? Can you give me your opinion on who do you think looks like they know what they're doing? You'd be amazed what we can find off a website that'll tell you if they kind of know their stuff.
And what about people looking for financial planners in their area? Where do they start doing something like that?
Okay. All right. So first of all, you want somebody who's a fiduciary. And there are some people who are and some people who aren't. And all that means is that somebody who's held to what's called a fiduciary standard is required to give you the best advice for you. It's a legal requirement that they're held to the best advice for you, not them. So if someone's a certified financial planner, CFP, that would help. But it also matters if their firm that they work for is a fiduciary. So you can have a CFP who works for Merrill Lynch, not knocking Merrill Lynch. I used to work there at one point in time. Merrill Lynch is not a fiduciary. So Merrill Lynch will not back that person up, okay? If they work for an independent firm, you hear about all these independent firms, they may or may not be a fiduciary. The form you're looking for, you ask them to give you what's called an ADV form. Apple, Delta, Victor, ADV form. That's the form they have to file with the SEC for the firm that reaffirms their compliance with all the SEC rules and the fiduciary standard. If they can't come up with that form, they're not a fiduciary. That's it. Now, that doesn't mean they're bad advisors. You just need to know who you're dealing with, okay? So that's first. You want somebody who's a fiduciary. If you have a financial planning association in your state, Financial Planning Association is the professional organization for certified financial planners, so it's a good place to start. You could ask friends. You could ask, I don't know, if PMD, I'm happy to talk to you. Let me back up and tell you. So part of my practice, especially because I have a lot of people who call me and say, my husband just got diagnosed. My wife just got diagnosed. Anybody who knows about Parkinson's knows me. I get everybody's phone calls. What I do is I will do a consultation for free for up to 90 minutes. And these days it's all virtual or over the phone, and discuss what your questions are or what their questions are and what they should do first, second, and third. And if they're in another state, then I can say, well, let me research and see who might work for you there. So I'm happy to be a conduit of that information. There are times where we can be helpful. There are times where we're not the appropriate place, but my job is to answer the questions. And when it comes to the Parkinson's community, I have a lot of sympathy. I mean, unfortunately, I'm walking the walk, so I know how it is.
Thank you, Debra. Oh my gosh. Okay, the questions are coming in.
Yay. You want questions.
Are living will and living trust the same thing?
Not necessarily. I've heard, and that's a great question. So a living trust is something that's prepared by an attorney that you sign, it's notarized, etc. A living will, a lot of times you can get those off the internet. It's kind of a loosey-goosey term, but some people use those terms interchangeably. When they have a living trust, they think it's a living will. So I would guess the first thing that you should do is, if you didn't have an attorney prepare it, at least have it reviewed by an elder care attorney and have them decide what you're missing.
Great.
Okay.
Won't transfer on death cover my assets? cash, stock, car, home, etc., at possibly no expense?
Possibly. Transfer on death is something that you tack onto accounts. And by the way, let me regress. I'm glad you asked that question because I left a little gray area. Transfer on death is a way of tacking a beneficiary code, if you will, onto an account that doesn't have a beneficiary. Your checking account, your car, okay? Your property. Is it the best way to hold property? Probably not. You're probably missing a lot of, there may be some tax situations that would be more beneficial, but it's better than nothing. It's way better than nothing. You don't do that for things that already have beneficiaries. Your IRA, your 401k, your life insurance. They already have listed beneficiaries. They will move without any issues with the state. They're already set up. They're a legal document where you've already written, here's where I want it to go. Okay. Transfer on death is a place that we have people do add the beneficiary designation, but depending on the asset, again, real estate, depending on your state, it may or may not be the best way to do it. If you do transfer on death to your kids, for example, they don't get the step up in basis, which eliminates the capital gain. So again, a client of mine's dad has lived in a beach house, this beautiful beach house overlooking Dana Point Beach, Dana Point Harbor, and it's worth $700,000. And he's lived there. He paid $30,000 for it a billion years ago. You know, like in the 50s. Well, if he had had transfer on death to his kids, the gain from 35,000 to 700 would still be there for them to pay taxes on, because it's in a trust and he's giving it to them in his trust. They inherit it, which eliminates that capital gain. So they get the entire value without any taxes due. So you see what I mean? It kind of depends on the size and the number, but it's a whole lot better to have transfer on death than nothing.
And this really, that's another example that goes back to making it easier on your kids and your heirs, right?
Well, it's super simple to have transfer on death, but if you just handed them a tax bill,
right?
Is that ideal? Not really. Again, nobody likes to deal with this stuff, but you know, our community deals with a lot of garbage we don't want to deal with. So, you know, it's just part of it.
Right. Okay, we have another one on trusts and wills. If you have a living trust and a pour over will, does the will piece go through probate? And this person is in California.
If you've got a pour over will, the whole idea there is they know that we forget to tell them things, or we know that you have your trust set up in, you know, 1 year and 15 years later, it's still there, but you've opened other accounts. The pour over basically says, oh, if there's anything out there we forgot, it belongs in the trust. So yes, it avoids the probate. It just gathers all that stuff you've never updated on your trust document and dumps it in the trust as well.
Oh, this is a good one. Okay, when you transfer property out of the patient's hands, isn't there a rule for how many years before going into a facility have to transpire?
Excellent question. Good catch. Yes, 5 years. 5.
Great.
Yeah.
That was Judy. Thank you, Judy.
Thank you, Judy. Good catch.
Okay, I did my original trust with commercial software. When my wife passed away, I had to restate the trust, but this time I had it done by an attorney. What a difference. His work was so much more comprehensive and complete. Oh, this isn't a question. It's just a comment. Sorry, Ken.
Comment.
Thank you. Thank you for that, Ken. I'd recommend a competent lawyer. Don't do it yourself with the software. Do you have an opinion on that?
No, that's a really good point. So you can do anything online these days, right? Anything. You can start a company, you can get married, there's all this software. I always say to people, would you take your medical advice from WebMD, or would you do your research on WebMD and then go see your neurologist? It's just like that. A human being is going to customize the documents that they're doing to fit your unique situation, your unique family, everything that's about you personally. You know, and again, if you're nobody here is, sorry, folks. If you're 25 years old and you just got married and you have no kids, okay, fine. You know, maybe you do it online just to have something, right? You're going to go to the Bahamas. You just want to cover yourself. But Ken's 100% right. You need a human being just to ask the questions you don't know to ask. I mean, isn't that where we all get in trouble? We ask a question we didn't know we should ask that other question. That's what the human element will give you. And a lot of people are worried it's going to be expensive. There's a variety of price ranges. There are some people who do that concierge model. It's very much like medicine, you know, that concierge model where there's a big ticket at the beginning, but then they kind of wrap their arms around you, and every 18 months they check back in, or every 2 years they check back in, and every time there's a change in the tax law that is relevant to you, they change automatically. I mean, you're part of the family, if you will. There are other people who will just do it cheap. Cheap is a relative word, I know, but they'll do it. They'll take care of it. They're there if you need something changed. Here's one thing I will mention. So my dad was an estate planning attorney, and he was a sole practitioner, and he literally dropped dead of a heart attack one day. And unfortunately, all the people who he had estate plans for, he didn't have anyone else in his firm who knew what was going on because he was by himself. That taught me that when you pick an estate planning attorney, if it's a human being, you do want to have some thought in the back of your mind of, well, how big is this firm? Is it just this person? And then you ask them. If it's only them, it doesn't mean it's bad. Just say, hey, if you were to drop dead tomorrow, who would I go to? Because that's where the estate planning attorney comes in handy as well. Is one of my challenges when my dad died. I mean, I know everything about this, right? This is what I do for a living. I was in such a fog, and this is what people forget. I was in such a fog. I would have given anything to have an estate planning attorney to go to and say, tell me what to do. I don't know what to do. It was really hard, and I know what I'm doing. Mm-hmm. So just think in terms of if it's a sole practitioner, what's their backup? They will have one, and if they don't, they should. And if they don't, you don't want to use them, I'm afraid. But there you go.
Great advice. We have a couple more. What's the difference between a bequest and a beneficiary designation on a life insurance policy?
Ooh, I don't know exactly.
Okay.
I would say ask the insurance company if there's a difference. It sounds to me, bequest, beneficiary. I don't know. I don't want to say that I don't. I mean, I can look it up if you needed to, but I think you want to check. Just call the insurance company. They'll tell you.
Quickly, could you touch on the CARE Act and how that affects donations? This question is, if I take the standard deduction when I file my taxes, can I still claim the CARE Act deduction?
Yes, thank you for clarifying and asking again, because some of that stuff goes by us. What they did in the CARE Act is if you just do the standard deduction, you can deduct up to $300 in donations this year. Okay. Previous to that, if you did the standard deduction, you could deduct no charitable donations. So you can donate $300 this year and get a tax benefit out of it, even if you get the standard deduction.
Okay.
I'm guessing it's going to be on the form.
Let's see. I do have a list of questions from ahead of time. I'm trying to see if we've covered all of them. I'm thinking about donating appreciated stock to PMD Alliance. Can PMD Alliance accept appreciated stock? What do we do with it?
Yes, they can. We had this conversation. We were setting this up, and I said, do you guys have an account for that? And they said, we're thinking about it. I said, we can do that for you. So what you do is you reach out to Amanda. Is Amanda who you reach out to, or Maureen? Talk to Maureen about what you have in mind, and she'll get me involved in the conversation, and we'll explain to you how it's done. And just so you know, we make $0 on this. This is a complete complimentary sort of thing. Nobody charges, we do it through Schwab, and Schwab, because we deal with Schwab on a large basis, Schwab doesn't charge anybody for transactions anymore. And most charities, I would say all charities, when they get a stock donation, the rule is it's sold immediately so they have the cash. So basically we sell it, we send them a check.
Here's one about land. We haven't talked a lot about that. I have a piece of land that I inherited 20 years ago. Can you talk more about the tax advantages of donating it to PMD Alliance?
Mm-hmm. I'm assuming it's worth more today. And it would work the same as any piece of property where if you were to donate it, you donate it at the current market value. So your tax deduction is the current market value. And I would probably suggest that we talk to someone we'd want to talk to someone and see what the best way is to do it. I think you'd probably put it into a trust, but if you wanted to do it upon your death, it's definitely something that, you can donate. But again, if you want the tax benefit now, you probably want to donate it before you die. So again, that's a conversation for your estate planning attorney, and they can talk with Maureen and your tax person. I know there's a lot of people involved, but what can I tell you? You want to do it right.
Judy, that's a great question. When you say this year, Debra, are you referring to 2019 taxes or 2020 taxes?
2020, baby. 2020. By the way, you have to have your taxes in by Wednesday, the 15th of July, right? For 2019, Wednesday. It's a deadline. Or you have to extend, one of the two. But yes, when I say this year, I mean 2020.
Okay. We could be here all day talking about 2020.
Oh, let's not.
Let's not. Does anybody else have any more questions? We had a lot. This was really great. Debra, is there anything you feel like we missed?
No, I think we covered it. And as you can see, one of the things that I find the most interesting about what I do is it's not the same. Everybody's got a different variation on their situation. So that's again why having someone just brainstorm with you about what the right strategy is for you and your family is so valuable. And like I said, I can tell you that many elder care attorneys hesitate to do something for free. Let me talk about that. What should you expect to pay? So you want to go talk to some elder care attorney and get their impression of what you should do. Okay. Well, being the daughter of an attorney, I can tell you they charge by the hour. They make money by the hour. And they can't afford to give it away for free because I can tell you what happens is people come in, they spend an hour of their time, they leave, they never hear from them again. Or worse, and I know no one here would do that, but I mean, they come in, they get an estimate of what it's going to cost, they get a little bit of sticker shock, they leave, and then they go have somebody cheaper take the idea and do it. So that's unfair. So when you go to see an elder care attorney, expect they're going to charge you $150, $200, $300 for the hour, but ask them if once you hire them, if they can apply that to your fee, because typically it's a flat fee. But do not expect them to give you their time for free. It just isn't fair. Now, that's one of the things that I do. That's why I say we can do it for free. And what I'll do is I talk to people about these situations. I say, okay, well, here are the questions that I would be asking. And here's what I already know that would answer some of your other questions. I know a number of people had asked about the time frame. There's absolutely that 5-year time frame. But there might be some other little subtleties about your situation. Well, we can do a little research on it, or we can reach out to an estate planning attorney we know and say, hey, here's a scenario. What are best practices? So that's part of, think of us as a general contractor and the estate planning attorney is a specialist. We're the general. We can talk to you about general conversations, general questions. And again, for anybody in PMD, I'm happy to offer some time, limited time, but we can set up an hour and a half conversation.
Thank you, Debra. We do have one more question.
Okay.
I have a trust that was established in 1990. It's gone through revisions, but things are much simpler now. Should I redo the trust and simplify the document?
When was the question would be, when was the last time you had your attorney look at it? And if you have a relationship with an estate planning attorney or an estate firm, I would call them. And believe me, they're busy. They don't need to jam you for a fee just for fun. Trust me, they're insanely busy. But say, hey, will you check, when was the last time I updated this? Has anything changed? My situation's simpler. Can I have you review it? Because you've already paid them. Can I have you review it and give me recommendations for what, if anything, I should do differently, or is it fine the way it is? Okay, so throw it back at them and ask them. There have been some changes to the estate planning law along with the tax update in 2017 that did change some things and made a lot of trusts now are more complex than they need to be. So it's a fair question. They will expect it.
Thank you, Debra. I think we got to all of them, and I want to leave a little time for Sarah to wrap up. Debra, do you have any final thoughts for everybody?
No, I'm happy that I can do this, and I love all the great questions. Thank you, everybody. You're obviously very educated on these issues, but you know, if I can do anything to help, let me know.
Thank you, Debra. Thank you for sharing your knowledge, and thank you all for joining us. We were really excited to have this first series as part of our Legacy Circle. The philanthropy team is working hard to put on programs like this. And before I hand it to Sarah, I do want to mention one more philanthropy program that's coming up starting next Monday, the Inspire Me raffle. It's our first ever online raffle featuring artwork from people whose lives have been impacted by movement disorders. We're really, really excited. It's a creative project. Friends, family, anybody can buy a ticket to win a piece of artwork submitted by people just like us. So thank you all for supporting the philanthropy team. We're so happy to see so many familiar faces.
Hey, Amanda.
Yeah.
I noticed somebody asked if there's some way they can save the chat questions. I don't know if you've ever addressed that before.
I actually do not know. Let me have Sarah.
I just put in the chat that I'm not sure why you can't download. It's probably just a setting on our end, but I'm going to download it. And anybody who'd like it, just Ken, I'll send it direct to you since I know your contact. But anybody else who wants it, if you can just email info@pmdalliance.org, and we'll be happy to get that to you, no problem.
Thank you, Rebecca. And with that, I will let Sarah wrap it up for us.
Wonderful. Thank you. This was incredible. I mean, I have listened to some of these talks, but I just feel like the information you shared was practical and, you know, I could wrap my head around it. So that was really, really helpful. Thank you. And I will have to work on a trust as opposed to the will thing. So that's really good to know. I mean, this was an amazing series. I'm so glad that many of you, I saw you on all the different parts of it, but starting out with our 5 wishes, then moving to the advanced care planning and putting a bow on it with leaving a legacy. What an impactful, powerful 3 hours we got to spend together. We're really grateful for your engagement and your support. And as you want to hear more, learn more, things that interest you, additional live streams you want to hear about, you know, let us know. We are always looking for topics that you want to learn more about. And I feel like the last 3 were wonderful overviews of some really great pieces. But if you want to dive in to some particular aspects, we can talk about it. Debra, I can't thank you enough for your time and just your partnership. It's been wonderful being able to work with you. And
absolutely.
Even if I can't see you in person right now, at least it's nice to see you here. And I do want to go to the beach that's behind you.
I know. So, come on to the patio. Come on.
Exactly. I'm coming over. Thank you all for being here. And we can't wait to see you maybe tomorrow at another one of our programs. So thank you, everyone.
Bye.
Bye,
The little PMD Alliance wave. Bye. Thanks.